Hi everyone, this video is dedicated to hedging strategy and more specifically to accounting piece of hedging strategy. I will just elaborate it once again. Accounting is a piece of your hedging strategy. Like literally, I mean it. You should own your accounting, not to pay double. That's the purpose of make accounting as an in-house exercise. Okay, I will go straight to the accounting piece. I will use a little bit of whiteboard to help me, and I will share my findings on AI in terms of if it's possible to create journal entry for forward contracts used as a hedging, and if it works good and how much time did it take from me. Okay, let's move on. What I'm doing in my work. I'm creating a robust instruction, step-by-step guideline, really detailed. And I use AI for this as well. So what I'm doing, I'm turning the microphone on and I'm dictating. Then I'm asking AI to rewrite it structurally. Then I'm checking it, making corrections. Then I'm running it through AI again and again and again. I do this iteration, I don't know, 5-10 times. It depends on the complexity of the file. And I'm creating the file myself according to the instruction I've wrote. Then I'm checking the file. Then I'm doing the file for the next period again. And after that, I'm asking AI to do the same file for the following period according to the instruction I wrote. And guess what? It does it well. I mean, it depends on the AI agent you're using. I've tried several, but powerful models do these at the human level, at the expert level. So use it. Like, why not? Do it a couple of times yourself to understand the concept, to check what your model is doing for you, and then use it. Do it, and that's it. You automated your hedge accounting. Now it's in-house and automated. Okay, this is on my instruction. What is written here? Of course, it's more detailed in the file, and it's more like micro action based, but the high level is this. First, download or get mark-to-market report from all your brokers and paste this mark-to-market report into the workbook. Okay? By the way, in the mark-to-market report, you already have your asset or liability position. So that's kind of ready to go number you can put into your accounting. Almost. You should check if it shows company position or bank broker position. When you check it, you have to put it into instruction, because otherwise AI will not notice these as a separate point. It will do it straight. I mean, don't treat AI as something unusual. It's been there with us. We just use engineer to put it into the code. Now you don't need an engineer who will write the code for you. It can be done with AI, but you are the one who are giving instruction to AI. That's your goal. You have to provide precise instruction, and more precise you are, the better result you get. It's not about AI not working properly. It's about you not providing enough instructions for AI to work properly. It's just another level of automation. Okay, here, is it company position, a bank position? Provide explicit instruction to your AI agent or AI agents. Second, you have to add risk premium. I'll explain. You will discount your asset or liability. For assets, it's less applicable, but anyways, I mean, if you have asset liability, if you have asset position with your bank, you have a risk of counterparty, known as credit risk. So you have to add this risk, then you discounting your position, making it in the present value terms. And if you're dealing with a big broker or big bank, this premium normally kind of 0.15, I would say. And if you hedge not that long ahead, adding this amount of percentage to your discount rate will not make material difference, but it's better to document this as well. But if you have liability position and you're not Apple, then you have to add risk premium. And the risk premium identified in several ways. Normally, you can use the rate you borrow at, especially if it's at the same term as your hedging position. It will work perfectly. Otherwise, you can again work with AI, check what are the criteria. There are a lot of models how to calculate risk premium and credit risk for your company, and it's simple for this purpose. You don't need to go that deep, because it normally doesn't affect that much if you use 3 or 3.5% as a risk premium for your credit risk. Where to add this component? This is for asset, more likely. 3-6% for liability. Where to add this? You should add this to your mark-to-market value, because mark-to-market value is calculated based on a risk-free rate. But check with your bank. They will disclose it. Check the methodology. They normally do not disclose much details, like what particular model, what particular inputs are used, but they will tell you if your credit risk included into the model or not. This is not a secret. Okay, now you have your mark-to-market report. You added your credit risk here. You've explained this into instructions step by step, like literally you are receiving report, you're making a note into instruction. You're converting the report into another format, you're making a note into instruction. That is help to automate the flow, to have less pain later on. Okay, third one. So here you basically have your posting already. A couple of more tweaks. You should add chart of accounts. And show where to put your asset or liability, because AI and your team will not know for granted, or you should create separate accounts for hedging. It just helps a lot when you prepare financial statements. Okay, chart of account plus mapping. If you hedge longer than 1 year, you will have 2 accounts for assets, short-term asset and long-term asset, and 2 accounts for liabilities. Same, short term and long term. Okay, after the mapping and discounting it to the present value, you can just make your posting. Again, straight format. It's just debit, hedge asset, credit, other comprehensive income if you are qualified for the hedged accounting, or it's vice versa. It's debit, other comprehensive income, and it's credit, hedge liability. Okay, that's the first part for asset and liability, but also you have your current item, current profit and loss statement. And profit and loss charge, I would say. Don't be strict with naming. But overall idea is that long ago, maybe not that long, maybe a couple of months ago, you hedged to protect your cash flow hedging, to protect your cash flow against currency exchange fluctuations. So, what does it mean for you? You, in the past, you are designed your activity in the way you will have certain rate in the future, but your current P&L is calculated at PL average FX. Yeah. And it's actual, it's kind of fact. And you have your contract that expired, that hit your bank account as a foreign currency and withdrawn in your local currency at certain rate that is different from your accounting rate. So it triggers somewhere foreign exchange rate in your profit and loss statement, foreign exchange difference, sorry. And what you should do, you should transfer from here Forex in the amount to make your profit and loss OPEX equal to the OPEX that was designed before for the amount of exposure. Let's say 1 year ago you hedged 1 million euro at 1.2 against USD. You functional with United States dollars. So 1 year ago you decided to have your 1 million euro converted exactly to $1,200,000. And that's what this about. Here is not this. So you have to adjust it to make it as designed OPEX. So your 1.2 million USD. Okay, I think that's it. You can watch other videos to understand this in more details. It's a little bit tricky to understand, but not that difficult. Everything else is all just about write good instruction, run it a couple of times yourself, tweak all the bugs, and upload it to AI and test it. And pay a little bit more for the powerful models. It will save you a lot of time. You can just calculate pros and cons. You can calculate your hour rate and the hours you save using AI. versus cost you're paying for the tokens to make this exercise happen. Okay, thanks for watching me. See you soon.